good afternoon or good morning to you, depending on what part of the country you're joining us from. Really looking forward to spending the next hour or so with you and hearing from Jeffrey Kleintop, who is the Chief Global Investment Strategist at Charles Schwab, and looking forward to his thoughts and insights on the global stage. My name's Brad Kelly. I'm the principal in charge of Eide Bailly Financial Services. And it's hard to believe it's been a year since you joined us, Jeffrey, and shared your thoughts and insights at that time. And I know your comments were really well received by our CPAs and our clients. We've received really positive feedback on your time with us. And, I was thinking about this today and thinking about a year ago at this time from a global stage standpoint. There was a lot to talk about, just coming out of an election. And as we were contemplating really going into 2021, there was a lot to consider. Fast forward to now, at this point in time, there's still a lot to talk about from a global stage standpoint. The things maybe have changed a little bit, but still plenty to talk about. So really looking forward to hearing what you have to say to us today. I mentioned to you earlier that I saw you on CNBC on Friday, and maybe got a sneak preview on some of the things you're going to be sharing with us today. So really looking forward to that. Before I turn it over to you, just what Amy said, I highly encourage you to ask your questions through the Q&A section of the platform. Jeffrey will be sharing with us some slides for about 30 or 40 minutes or so, and then we'll spend the last 20 minutes of our time together responding to your questions. So make sure that you utilize that and ask your questions. And Jeffrey, thank you so much for being with us today. It is a privilege to have you, and we look forward to hearing from you. So I'll turn it over to you.
Thanks. It's an honor to be back. I'm thrilled to talk to all of you. I have so many things I want to talk about, but what's even more important than what I want to talk about is what's on your mind. So there's plenty of things I'm going to bring up, but there's probably lots of things I don't dive as deep into as you might want, or subjects I don't even get to touch on. So please get your questions in, and Brad and I will have that discussion after the end of my prepared slides here. So let me bring these up.
As you're doing that, I just say, because things are changing so fast with news coming out of the White House today and so on with the Fed, Jeffrey was updating his slides right up to the last minute here. So we're
So I'll tell you what, maybe we can go with the prepared deck, and I'll slide through those. So not that there's any real difference here, but I do, as Brad noted, I do have a tendency to change things on the fly. So I'll just note anything that I might have updated here as we go through this deck. So, and here we are. So here are the main topics that I want to cover with all of you. I want to talk about this move from recovery to expansion. We're no longer in a recovery anymore. I talk about it a lot. Politicians and others, hey, we're in a recovery. No, we're not actually. I'll talk about what that means for the markets. And then I want to talk about inflation. It's the biggest risk to our growth outlook. And I actually think the risks are skewed to the other side, that we actually see inflation turn around in a big way next year. I think I'm going to surprise a lot of people. Talk about why. I want to talk about these supply and labor shortages that are going to drive that as they turn into a glut, particularly on the supply side. And then I want to talk about this new cycle that we're in and how I think we're going to see some new leadership as time goes on. And then I want to talk to you a bit about China as well. A lot going on there, a little bit out of sync from the rest of the world. So I've kind of separated as a separate topic. So let me talk about this move from recovery to expansion. This blue line, super simple. It's just global economic growth. It's, or not even growth, but it's the total value of all the goods and services we produce in the global economy measured in dollars. And so you can see the peak there in 2019, of course, the very deep V-shaped recession and recovery. But now we're beyond the prior peak. We've been there now for a couple of quarters. As of the second quarter, we crossed over the prior peak, and here we are now with the third quarter adding, into the fourth quarter adding further to that. We're now in an expansion, new all-time highs in terms of global economic output. That doesn't mean every country or business or family is back to where they were, but overall the global economy is. And what happens is usually once we get into that, and we've been there for most of the year, we start to see more economically sensitive companies perform well. It isn't just the companies that that fell the most that bounce back the hardest. That's often the case during the recovery. But once you're in an expansion, it's a new group of companies, more economically sensitive. And we have seen value stocks lead the market this year, right? Financials, energy. It hasn't been tech. And that's really been interesting and a real shift that once we got into this expansion, we started to see. And that's why it's an important distinction that often comes into play. It usually takes years to get through the recovery. And that's why it's so remarkable. We had a recession and recovery contained in 5 quarters. That has never happened before. We've got lots of data on the US going back 100 years. I've got pretty good data on Spain and the UK going back about 800 years. This has never happened before. And we all know why, right? Because of the restrictions and the lifting of those. But wow, what an incredible snapback in a new phase of the cycle now with new leadership taking place. But this may be the most important chart I share with you. I'm probably going to say that about 5 times, but for different charts. But this is one of my favorites right now, and it is the lead chart in my global 2022 outlook, which publishes today in just about an hour. And this is the sneak preview. This is the growth rate for the global economy. So the prior slide was the amount in dollars, but this is the annual percent change in those dollars. And, naturally our eyes are kind of drawn to the end of this. This is a 50-year chart. You see that big dip down in 2020, the deepest recession in 50 years, but then this incredible rebound this year, deep into the green, booming territory, and next year as well. So that's where that line is dipping down to. About a 5% growth rate, 4.9 to be exact, is what is forecast for 2022 by the IMF, by the OECD, by the World Bank, by us as well. This is still a very strong growth rate. So the world economy is slowing, but it's not slow. And I think that's something many investors are missing. They're focused on, well, not in the markets lately, right? They've been hitting new all-time highs, but I think there was increasing concern that next year might be a very difficult year as growth slows. Well, but it's still really strong and growing at a very much an above average pace. In fact, if you look back, we haven't seen a back-to-back years of global economic growth this strong since 1973. It's been 50 years. I don't know how many generations that is. I don't know how we measure them anymore. That's like Gen X and millennials and Gen Z. It's like 3 generations. It's been a long time. Really powerful growth. And that's an important message because I'm going to talk to you about COVID and inflation and shortages and rate hikes that are coming, a lot of risks, and they're going to get a lot of attention next year. But I don't want to miss the fact that global economic growth is incredibly strong. And that's going to help kind of float this economy over those rocky risks so that we're not going to run aground. It means a lot, right? It's a rising tide of growth, and that's really important. So I'm going to end my discussion of that very bright outlook right there because I'm going to get into the risks now, but it's really important. And it's one of the reasons why earnings growth is going to continue next year and why we can, I think, sustain these higher than average valuations because growth remains so strong. We know a lot of the reasons: fiscal support, monetary support, et cetera, but the fact is it's pretty good. Now, let me talk about Delta. It's not even Delta anymore, right? It's COVID just continuing. It's becoming endemic rather than a pandemic. It's just something we're living with. It's got waves where it comes and it goes and it comes and it goes. And it's not just a big wave and then gone. These are the vaccination rates across major countries. And you may have seen in the paper, Austria just shut down, just went into lockdown. Everybody stay home because they're in their 4th COVID wave. Austria's got a pretty high vaccination rate. It's similar to Germany's, around 80%. Europe has a tendency to invoke restrictions when COVID cases go up. The US doesn't. We're in the kind of live with it mode here. But I think that over the course of the full winter, we're already seeing cases rise in about 30 different states. That may continue. And the US may be more vulnerable at a 57 or 58% vaccination rate relative to Europe and Asia, even Brazil at this point, of a significant wave. So we're not past it yet from a market perspective. I don't think we're going to see hospitalization rates anywhere near where they were. And thankfully, hopefully we don't see, oops, I just jumped past it. Hopefully we don't see death rates anywhere near what we've been seeing in the past. Real quick, this chart, the orange line is the number of deaths in the UK, and the blue line is the number of cases. I'm using the UK because they got their Delta wave before everybody else this summer, but it never went away. They're still seeing a really high number of overall COVID cases in the UK, not invoking any lockdowns or restrictions really at all, but the death count remains fairly low. I mean, any death is a tragedy from this, certainly, but the deaths are very, very low. Hospitals are not overwhelmed in the vast majority of cities in the UK, so they're not invoking these shutdowns. So the economic consequences may not be as dire as we saw with Delta or others, but there may still be psychological consequences that could have an impact on the markets. And we've certainly seen that this year. Every wave of COVID cases has corresponded with tech leadership. So when the case count's going up globally, tech stocks have been outperforming. When the case count's coming down, energy stocks, reopening, travel stocks performed well. And that's happening again right now. We've seen this big uptick in global COVID cases, and tech has taken over leadership. And this just has played out all year, up and down, up and down, up and down, up and down 4 times. And it's now up again. And I don't know when this is going to end. Hopefully, we're past this wave fairly soon. China appears to have passed it before the rest of us. Europe's in the midst of it right now. It seems to be growing in the US. Maybe by late December it's over, or maybe it lingers through the entire flu season. I don't know, but it's certainly a risk to market performance. And relative performance in terms of what sectors perform the best. So definitely still a major market factor and a risk for next year. Now, inflation is probably the biggest risk that everyone's focused on. What comes with strong growth? Yeah, higher prices, sure, because demand is outstripping supply. But I want to break this down because I think there's a lot of interesting things going on right now. First of all, inflation is not really global at the moment. This chart shows core inflation, stripping out food and energy prices. I know food and energy count. We all eat and travel. But just to look at the underlying trend in inflation, it wouldn't look dramatically different if I left food and energy in here. But I just wanted to show you the underlying trends in all of this. The blue line is the US, inflation in the US, pretty high, way above what we're used to seeing for the last 5 years. But look at Europe. I mean, it's high, but not super high relative to the last 5 years. Now look at, that's orange. Look at Japan, the green line. It's actually negative and below the average of the last 5 years. So inflation has not been a global phenomenon this time. It usually is. It's not now. It's really in the US, the UK, and Canada. Those are really the 3 countries experiencing notable inflation. Everybody else, not really. And that has meant it's been more of a burden on the Fed to address than other central banks around the world. So why? Let me get to why has inflation been worse in the US? Well, part of it had to do with the fact that we reopened before everybody else. So demand came back earlier while they were still supply chain issues, right? Because not all the port workers came back at the same time. People started, doing more shopping and traveling. So we ended up with these supply chain log jams, and that had a lot to do. Pushing up about 2% of that rise in prices is just due to supply chain issues. So that's the bulk of it. And I want to focus on that first because I think it's really important. We're past the worst of it. I believe we're past the worst of it. One of the best ways I can find to track this, and I track it a lot of different ways. I look at port congestion every day, and I have for years. It's a great way to see how things are moving around the world. But I also like to track the cost of moving one of those big containers, one of those big metal containers on the world's most popular route from Shanghai to LA. And that's what you're seeing on this chart. The orange line is last year. And the blue line is this year. Now, they're at different levels because it cost a lot more to ship this year because of the shortages, but they follow the same pattern just about every year. The peak of shipping demand is always like the last week of September. That's when everything's on a ship trying to get to distribution centers in the US ahead of Black Friday. And sure enough, that's what happened last year, and then prices leveled off. This year we hit that, and then the price to ship one of those units is down 30%. And that's big. And it really shows you how demand is pulling back. Now, you may know, because it's in the paper, because President Biden's talked about this, there's a tremendous backup of ships in ports. There's really only 2 ports that are backed up in the US, Savannah, Georgia, and most notably, the ports of Los Angeles and Long Beach off of Southern California. And those ports right now have over 70 ships waiting in Southern California. Here's the thing. Because of the demand for ships and how many of them are waiting, we're actually starting to use smaller ships than we usually use. So yes, there's over 70 ships waiting, but the number of containers waiting is nowhere near that severe, right? Because some of the ships only hold about half the normal number of containers. And the point of all this is we're actually seeing the number of containers come down that are waiting. Last week, we heard from Walmart and TJ Maxx and Target that they're fine. They're fully stocked for the holidays. So I don't think we're going to see the kind of shortages everybody was worried about further pushing up prices. We seem to be seeing prices come down now to ship, and a lot of those items getting distributed. And this is my thought about, looking out to next year. Very often shortages turn to gluts. Doesn't usually go the other way around, but almost always shortages quickly turn into gluts. And how fast they turn into gluts can surprise people. This is last year with personal protection equipment, masks and gloves. The world's biggest glove maker is a company called Top Glove, and they're based in Malaysia. This is what happened to their earnings estimates and their stock price in 2020, right? Pandemic hits, they surged. Earnings estimates went up 1,400%. The stock soared 400%. Like, we're all going to be wearing gloves everywhere forever. And what happened, of course, right around the time the vaccines came out, no surprise. Stock price came all the way back. So did earnings estimates. Shortages turn into gluts very quickly. We saw it even this year in coal prices. In fact, I was going to update this chart. They plunged even further. So this year there was a shortage in coal. We know these energy shortages have been pushing up inflation, particularly in China. It's very, very, very underweight coal. Coal inventories were very low, and we saw a huge run up in coal prices, particularly from Australia, big coal producer. And then China decided to reopen some mines, authorize new mines, and next thing you know, coal prices plunged. They literally crashed, and so did the stock prices of coal miners. So this move from shortages to gluts, like overnight, can happen very quickly. Where could it happen? It could happen with semiconductors. It's happened many times with semiconductors. We all know they're in short supply right now, particularly the high-end logic chips that run cars and so many other things that we're in short supply of. This is the sales cycle for semiconductors. No question, we're putting semiconductors in more and more and more and more things over time. So there's long-term demand for them, but there are big booms and busts in ordering, right? Orders pick up, and then there's overordering and triple overordering because they're short. And then you see this gap as orders plunge. And guess what? So do the stock prices of semi companies when those orders dry up, typically by 30%. So we're in this run up right now. You can see the latest run up in terms of sales demand. And there's probably another month or two of demand on here. And then if it begins to roll back over again, you could expect to see maybe a pullback in some of those stocks. And remember, it's not just semiconductors, it's everything they go into. We know automakers have lots full of cars waiting for chips. And once those chips come, where are those cars going to go? They're going to flood dealers' lots. So, and same thing for game consoles and phones that are in short supply. We could really see a big rush of product, finished goods product, and that can really pull down on prices. Now, this may happen over the course of the first half of next year. It's really the second half of next year where I'd expect to see prices really coming down. We can be worried about deflation again as a lot of these prices pull back. So I think we're going to see a pretty sharp turn between worries about inflation to not so worried about inflation in the second half of next year, at least as it relates to a lot of these categories. And that means just as the Fed's thinking about hiking interest rates as their tapering of their bond program ends at the end of June, I think the market's going to have to rethink their expectations for how many rate hikes the Fed's going to do, given the backdrop of receding inflationary pressures at that time. So I am not that worried about inflation. Is it a risk that I'm totally wrong on this? Yeah, but I don't think so. We've seen this happen again and again. And already I'm hearing from automakers that their semiconductor shipments are coming in. They're past the peak of the shortages. VW has said that. Ford has said that. GM has said that. Toyota has said that. So they're saying, look, we're getting them now and we're beginning to deliver. So we'll see how that begins to shape up. The other thing I would just throw out there is this is orders for new container ships. The ships that carry around all those containers. Look, during the trade war, the number of those ships on order really fell, right? Oh, deglobalization, nobody's going to buy anything anymore. And then look at this spike. So even container ships themselves, we could have a glut of container ships out there. The reverse of the shortage we're in right now as these prices to ship begin to come down. So I just think it's interesting to ponder this shift from shortages to gluts. The other thing, and I'll just bring this up quickly, is labor and wages. In the 1970s, we saw labor contracts, particularly union labor contracts, but minimum wages as well, get tied to inflation. So when inflation went up, wages went up, and that made inflation go up. Wages went up, and that made inflation go up. It was called the inflationary spiral. And we saw that in the 1970s. And there's some concern that we're seeing it now with all the union demands for higher wages and strikes taking place. And I'm sure you're seeing this in every local newspaper across the U.S., from bus workers in Maryland to steel workers in West Virginia to Kellogg's workers in Nebraska. Almost everywhere you look, there's some strike taking place. But I've got this chart to show you how different this is than the 1960s and 70s. This is the number of strikes taking place in the UK and the US. And I can show you Germany and Canada and so many other countries too. I just didn't want to clutter this chart. They all look the same. Yes, there are strikes. Yes, unions are getting some pay increases, but it doesn't look anything like the 70s. In fact, some of the latest pay deals, when you look at them over the term, they're really below the rate of inflation we're seeing right now, unlikely to spike further inflation. And where we're seeing wages tied to the minimum wage, like in Spain and France, where they tied their minimum wage to the rate of inflation. In September, I think Spain saw a 1.6% minimum wage increase for the next year. And last month in France, it was 2.2%. So nothing to worry about here in terms of further accelerating an inflationary move to the upside or compression of profit margins by businesses, which, by the way, are at all-time highs. I don't think we need to worry too much. Sorry, that was the one right here. This is profit margins for businesses, right? So what are they making? And profit margins are at 10-year plus highs, despite this rise in costs, shipping costs, energy costs, taxes possibly, and labor. Don't worry too much about this. I think profit margins are going to remain fairly high as some of the commodity prices come down, thanks to some of the gluts that begin to emerge. But the fact that wage increases are pretty much being passed along to the consumer in terms of inflation. In fact, inflation is running faster than these wage increases that we're seeing. So I don't think we're going to see much in terms of profit margin compression for businesses as we look out here over the next year or two. So that's the inflation picture. I'm not that concerned about it being a major problem as we look out to the next year or invoking more Fed rate hikes. It actually has a positive correlation with earnings growth. So if you take a look here, this is just inflation and earnings. I picked Europe here because there are more inflation sensitive companies in Europe's index, but the S&P 500 looks a bit like this too. When inflation's going up, earnings benefit from that. You see earnings go higher. The flip side is, will valuations head lower? And historically, we just haven't seen that. When we're in this kind of an environment, a pretty slow series of rate hikes. This is the policy rate for the world's major central banks. The blue line there is the weighted average of the largest 20 economies in the world, and what's their policy rate for their central bank, right? And you can see it's starting to creep up a little bit. The Fed isn't hiked here in the US, but some other central banks have started to increase rates, but it's at a very slow pace. It's unlikely to be a big V-shaped leap back that would really weigh on valuations as investors rethink what growth prospects look like or discount earnings from the future at a much higher discount rate, right? Seems unlikely. So while earnings get the benefit of inflation, I don't think valuations are going to suffer that much, given what I think will be a very slow pace of rate increase. I mean, really slow pace of rate increases over the coming next couple of years. And in fact, if we look historically, stocks have done pretty well in an environment where rates are going up. So real quick table here to just dispel any myths about how stocks perform when the Fed is hiking interest rates. People think, oh, they have to go down. They don't usually. So when central bank rates are below average and rising from a low level, actually stocks have done really well, right? Because it's a sign that the economy is doing well. And that's what stocks are keying off of. When rates are high and coming down, that's bad news because it means we're likely headed into a downturn and the economy and the Fed is responding to that. But we're now in an upturn, and that's why rates are rising from a low level, historically, the best period of time. So as the Fed's hiking interest rates, as long as growth remains robust, we should see pretty good returns in the stock market. So don't get too tied up in what the Fed means for the markets in the coming year. And so I want to talk about also this idea of new leadership in this cycle. The global investment market cycle, economic cycle, earnings cycle, all those cycles ended in 2020 with the recession, and we've started a new cycle. Some people might say, well, is this just maybe part two of the same economic and market cycle? It was just interrupted by this pandemic? I don't think so. A lot of the world's major economies were headed into a recession pre-pandemic. In the fourth quarter of 2019, Germany, France, Italy, Canada, Japan, and the UK all had negative GDP growth rates, meaning they were slipping into recession. They were zero or negative in pre-pandemic, fourth quarter of 2019. The US had its growth below average and earnings were falling, wasn't quite sliding into recession yet. So yeah, I think from a global perspective, it was definitely the end of the cycle. It just happened to be punctuated by a very, very deep and painful pandemic, but it could have been caused by a further exacerbation of the trade war or other things. But yes, we are in a new cycle starting at the end of April of 2020. That's when this new cycle began. And we believed, and I still believe, that the place to go is outside the US for investment leadership. And the last cycle was all about the US outperforming because global growth was below average. And when growth is below average, the less economically sensitive your revenue is, the better. And tech and healthcare companies, growth stocks dominating the US benchmarks, did really well. Now we're in a different cycle where growth is much stronger and inflation is much higher, and that favors international stocks, particularly in Europe, just as it did from 2000 to 2007, where international stocks were the best performers. So this was a cartoon we put out a little over a year ago, showing the baton of leadership being passed to Europe from the US. Well, it didn't exactly work out that way this year. Europe has lagged a little. It's actually been kind of right in line with the US. So this is the performance since this cycle started at the end of April of 2020. And the orange line is the performance of Europe's stock market in dollars, measured in dollars, like for investors based in the US. And the blue line is the S&P 500. And you can see international stocks, Europe stocks outperformed most of that time until we got to the fourth quarter. And we started to see the US stock market begin to outperform here. Why? COVID, picking back up again, that rotation back into tech and healthcare, and worries about growth, strength in the dollar that's tied to that, has all led the US to outperform. I don't know how long this will last, but I'm hoping this COVID wave is not nearly as severe or economically impactful as the others that we have seen, and that we will see a rotation back in economic leadership stocks and Europe. But it certainly has been not a great place to be here in the fourth quarter, as we've seen the US reestablish some leadership, at least here temporarily. But I think over the course of 2022, I should say, and the 2020s, I think we're going to see a shift more towards economically sensitive stocks and inflation sensitive stocks doing better, because I think inflation is going to be above average, or above the prior average, maybe call it 2 to 3% going forward, as opposed to maybe 1% that we saw for much of the last decade. And I think that creates a different environment for stocks and different leadership, and tends to favor international benchmarks because they have more in financials and energy and industrials, as opposed to just tech and healthcare. So we've seen this happen every economic cycle. Right. So, the last one from 2009 to 2020, US stocks outperformed. The one before that, from 2000 to 2008, international stocks. The cycle before that, from 91 to 1999, was U.S. stocks led by tech. In the 80s, it was international, led by Japan. In the 70s, it was back to the U.S. In the 60s, it was international. So we've always seen this flip each time as we get kind of different environment of leadership. And once again, all those catalysts have kicked in, not only in terms of relative economic and inflation momentum, but valuations as well. We are now at a record-wide gap between how the price earnings ratio for U.S. stocks and international stocks. And that usually begins to reverse at the start of a new cycle. So we might be on the cusp of that beginning to turn around. Now, I'll just wrap up here on China before I get to your questions. I'm really excited to hear what's important to all of you. China is kind of an outlier to all of this. China is the second biggest economy in the world, but it's been in its own little world this year, in part because it's taken a zero tolerance approach to COVID. So whenever there's a breakout in a city, not just a breakout, one case, the entire city of 8 to 10 million people gets locked down. They literally test every single person in the city and then quarantine anybody who's tested positive, and everybody else can go about their business. But it takes about 2 weeks. And it's happened again and again, and it's slowed their economy this year. And at the same time, you probably read about this regulatory crackdown on gaming companies and on education companies and on, most importantly, property developers. And there's been a lot of talk about, hey, is this like the Lehman Brothers event that precipitated the great financial crisis in the US and the rest of the world? No. These developers are like Pulte or Lennar or Toll Brothers, not a bank like Lehman Brothers. Very different in terms of its ramifications across the economic system. Evergrande, which is the target of much of these liquidity restraints, makes up about 4% of the new home market in China. And they're selling off those assets to other less leveraged development companies. It has led to a 1-month decline in Chinese home prices of 0.25%. Not a big deal so far. Since these restrictions began in July, that's the latest number. That's for October. If we get a string of those, if they get more dramatic, then I'd worry that the Chinese consumer would be very concerned about probably their biggest asset, their home, plunging in value, and that might have a problem. But so far, no problems outside of housing. The high-yield bond market is fine in China. In fact, every other high-yield bond issuer in China outside of property developers is trading at par or higher. It's doing great. Shibor, which is a interbank lending rate, is showing no signs of stress, so the banks aren't freaking out. Don't see this as any type of contagion issue in China at all, akin to the great financial crisis. But it is a risk factor, and it's one of the reasons why Chinese stocks have suffered this year. Take a look at this chart to finally get to it. The columns on this chart is the return for the year for Chinese stocks. The dot is the peak to trough decline during that year for Chinese stocks. This year was 33%. Big drop. But that's average. In fact, the average year sees a 28% decline, peak to trough in Chinese stocks. 17 of the last 20 years has seen a bear market in Chinese stocks. There's always a bear market happening in China, but there's always an equally sharp rebound on the other side. This period of time on this chart, last 20 years since China entered the World Trade Organization in 2001 to now in 2021, that period of time, Chinese stocks have returned a 12.3% return measured in dollars. The S&P 500 has done 9.3. So despite bear markets almost every year in China, it's outperformed the US by 3% a year for the last 20 years. And that's the thing to focus on here. China's always unveiling some new surprise regulatory or legislative development because they have one-party government. They can do that. Surprise, we made a change. And it freaks the market out a little bit. And we get worried and stocks pull back. And then the government steps in and enacts some easing measures like they're doing right now. To a number of different industries. In fact, they just announced some more this morning for small businesses, causing markets to stabilize and begin to rebound. And they usually rebound very quickly. This is the challenge of emerging markets. They move abruptly and dramatically, and it always looks like it's the end of the world. But what long-term investors know in the emerging markets is you are paid off holding over time, over 5, 10, 20 years. That incredible, painful volatility pays off. And that's why it's usually a small portion of our portfolios, because it's ugly to watch, but it pays off over time. And I think China's in that same position now, having pulled back the extent it usually does, is now basing. In fact, it really hasn't moved in the last 3 or 4 months. It's just kind of forming a base and likely to rebound here as we get more easing measures, targeted easing measures announced in the coming months. And you get a big snapback that'll be incredibly difficult to time. And many investors will miss it if they jumped out and try and jump back in again. And that's why China's its own little world in all of this, benefiting from rapid global economic growth. They're still an exporter and a big driver of that growth. The Chinese consumer is a huge driver of this. Singles Day, the world's biggest shopping day, took place on November 11th, and sales were up almost 10% from last year's pandemic spiked sales. The biggest sales day in the world, way bigger than Black Friday or Cyber Monday, is a Singles Day in China, and the consumer showed no signs of stress there. So I think we're seeing an indication that China is going to bounce back and be a good performer next year, but trying to time that is really difficult. And that's why a long-term allocation to emerging markets makes some sense. So, Brad, I'll just quick sum up here and then we'll get to these questions. First, global growth is slowing, but it is not slow. Don't mistake talk of a slowdown for a slow growth economy. This is a booming environment, even if it's a little slower than last year. Shortages could become gluts next year. I think that's good for inflation. I think it's coming down. I think that's good news for the Fed. They're not going to have to hike rates as aggressively. Good news for valuations on stocks. Could be bad news if we see chip maker stocks really rally and then pull back here on as expectations for sales begin to plunge. And watch out for automakers as well. They started to show some signs of life here. They're by no means overvalued on some kind of huge spike in demand, but if they were to spike up, I'd be a little worried if we started to see some gluts begin to emerge next year of all these cars hitting the lots at the same time. And then also labor markets, don't worry too much about them. I think they're fine. We should be seeing some wage increases here. We are. It's not like the 70s. And then finally, international markets may finally be on the cusp of really performing. They've done pretty well since this cycle started, but the fourth quarter has been a bit of a setback with this resumption of COVID in Europe and those lockdowns and a retreat to safety. But hopefully that begins to fade over the course of the winter here, and we see a return to cyclical leadership. So, oh boy, that was a lot, but I'm sure there's a lot of other things you'd love to talk about. So let me open this up and we see what questions have come in.
All right, sounds good. Thank you again, Jeffrey, for sharing your thoughts. So we do have questions that are coming in. Let's stick with the supply chain and the inflation conversation. So if inflation maybe isn't the risk maybe that's being talked about, the opposite, if we get the glut and now all of a sudden we have oversupply, could that potentially lead to deflation and maybe recession? What's the risk of that going that direction?
It's a possibility that we see a big drop in earnings expectations and sales expectations for a lot of these economically sensitive parts of the market. And that could cause a rotation back into defensives. But I don't think that's going to cause I don't think it's going to cause those businesses to shed payrolls, meaning that I don't think it's going to spiral into, earnings aren't what we thought. We've got to cut jobs. We've got to pull back. They're still fighting to get employees. So I don't think we'll see the economic recession come out of this, but prices easing back into an area that we're all more comfortable with. It means the Fed can stay on hold for longer and actually help bolster economic growth. Okay.
Couple of directions I'd like to go here, but let's stick with the inflation conversation. So real estate in particular, real estate's been hot across the country. What are you thinking as you look forward there? Is that going to continue? Do you see any real estate bubbles potentially taking place as we look, especially in the U.S. market?
I think bubbles, there could be some very localized bubbles, but not overall. The banks are not pulling back on lending, and there's no reason for them to. They're flush with cash. They've got massive reserves thanks to pretty much a decade of not doing a whole lot of lending. And the result of that is usually when we see busts in the housing market, it's not because interest rates shoot up. It's because you can't borrow at any cost, right? Banks just don't want to make the loan, so they make it really hard. And we're not seeing that at all. We're seeing very flexible loan arrangements. Banks are very willing to make loans to both businesses and homeowners, even as rates begin to creep a little bit higher here. And since wages are going right along with it, I don't think it's going to price people out of homes. So no, I am not worried about the housing market this time.
Okay. let's shift to the Fed. And let's talk a little bit about the big news today coming out of Washington. So Powell will continue to be, at least nominating to continue to be the leader of the Fed. But there's a lot going on in the membership level that I think we as investors should be mindful of. Do you want to speak into that a little bit?
I'd love to, Brad. This is a really important point. I'm glad you brought it up. So it's a big Powell party in the markets, the leaders there. And that's probably the only member of the Fed that the average person could name, right? Powell, if they're lucky enough to name one member of the Fed. But there are other folks on the Federal Open Market Committee that set interest rates. There are many Fed regional bank heads, presidents that rotate onto that committee each year. There's 5 voting members from those. And then there are governors who always get to vote, and they carry a lot of weight, and they hold 14-year terms. There's 1 slot open right now, and there will be 2 slots open early next year as Quarles and Clarida leave as a result of the sort of trading scandal that took place. That means Biden has 3 appointments to make to governors. Again, 14-year terms. He has the ability to stack the Fed. If you can't stack the Supreme Court, you can at least stack the Fed with perhaps very progressive nominees. Maybe Powell is a bit of a Trojan horse in a way. It makes it seem like, oh, nothing's changing. Powell's a Republican. I'm not doing anything radical here at the Fed. And maybe under that cover is able to slide in some very progressive nominees to those very long tenured terms that will far outlast Biden's presidency. And I think what's interesting there is we're at a point where central banks' mandates are evolving. The Fed in the past its job was to maintain keep a lid on inflation and maximize employment at the same time, because there's a trade-off between the two. The Fed has been much more focused on employment than inflation, because inflation has just been dead for so long. Now it's come back. But the European Central Bank just adopted climate change as part of their mandate in the past year. And they've made it a lot more flexible on the inflation side, saying we can let inflation overshoot 2%. Before the European Central Bank said inflation needs to be at or below 2. Now they're like, well, it could go a little higher. And we want to favor companies focused on green technologies and green investing with favorable borrowing rates. You could see something like that begin to happen elsewhere, and could happen at the Fed with a much more progressive membership. So I think the market today is saying that's it. The Fed's still probably going to hike a good bit next year because Powell's maybe a little hawkish. I'm not so sure in that interpretation, but I'm even less sure once we see these other nominees to the Fed Board of Governors. They may be very dovish, saying, no, keep rates very, very low, favor green investment, and really focus on the job side of the mandate, and not worry much about inflation. So I think that could evolve in the coming months as we see who that slate of nominees are, and the market could reinterpret what the Fed's set to do next year as we see those positions fill out.
Okay. Yeah, certainly something to watch as we go forward. Washington, let's talk a little bit about just the bill that was recently passed, and then the one that's being talked about right now. I mean, that's going to, one thing that I think we've seen during COVID is the liquidity that's been put into the system, whether that's been done by the Fed or by Washington. So this is going to be additional liquidity now coming into the market. How's that going to play into this inflation discussion?
Well, so the bill that was just passed, just enacted, is an infrastructure program with a really long life to it. So few things are shovel ready. Remember shovel ready, like a decade ago, coming out of the great financial crisis? Oh, we got all these shovel ready initiatives. Nothing is shovel ready. Everything, at least federal infrastructure, requires a lot of planning before you really do anything, right? So that's, a lot of engineering and construction firms, get money in for a couple of years. They do the planning. It's a long time before shovels actually hit the ground. Not that there's anything wrong with that. You need to plan. You need to do all these things. And that will play out over the next 10 years, but it's not like a spike into the economy right now that would drive up inflation in, say, cement or copper rebar or something like that. The other bill, though, is a little different. The other bill is targeted more towards social issues, and that money could begin to flow right away. That would likely further support prices, and because it would further drive demand in an environment where supply is having trouble keeping up. Now, it'll take a while to pass it and enact it and all that kind of stuff. So it may be coming at the same time a supply surge is bouncing back as the supply chain begins to heal itself. But there is some further potential inflationary consequences there. It's a very different environment than what we saw 10 years ago coming out of the great financial crisis, where there was much more of an emphasis on austerity, on fiscal prudence, particularly in Europe, where Europe actually ran budget surpluses from, I think, 2011 through 2019. No surpluses in sight now. Europe is, and Germany is like everybody else, spend, spend, spend. So with the entire world spending a lot more, it's another one of the reasons why inflation and economic growth is likely to remain above average.
Okay. How about the labor force? You did talk a little about wage inflation, but labor shortage. It seems like companies are having a harder time attracting and retaining talent. And what the great resignation, I think, is a term that's being thrown out there as well. But any thoughts on that? Do you think that's going to continue? Do you think, how do you see the workforce kind of evolving now and access to labor? How's that going to maybe play out?
It is tight. We've even seen it in countries like Japan, where traditionally you haven't seen a lot of female participation in the workforce. That has soared to levels we just never seen before, as so many people are brought in. It's funny. Just a few years ago, a common question that was asked in almost every Q&A session was, all the robots are going to take the jobs, and what are we going to do? All these people are going to be out of work. And the reality is, technology just creates its own jobs, and we're in that environment now. And I think we are seeing more businesses substitute capital for labor. Business expenditures are sharply on the rise, and we're seeing more and more of that. So you can expect to continue to, order your fast food at a kiosk and your movie tickets and at the airport and elsewhere, wherever we can cut people out of the equation, we're going to do that because we can put them to higher and better use. The challenge is where, so when you take a look at the National Federation of Independent Business, the big small business trade association in the US, they survey their members every month, of course, and their biggest complaint is we can't find qualified workers. The skill set is tough. They're willing to pay more. They just can't find people that can code or find people that can do, whatever it is they're looking for them to do. So a big part of this is education. And, it's interesting to see some other parts of the world seem to have this figured out, where they have, kind of secondary education programs where you can go for 6 months and learn how to code, even if you're 50. As I am, or there's a lot of retraining going on. We don't do a lot of that in the US. It's like once you're out of college age, it's kind of it, right? But that mobility of getting people, now it's not so much, well, there are people in Tennessee and we actually need them in, Oregon or something. That's less of an issue now with the mobility of work. It's more getting the right skills. And I think that we've got to relook at that education system. And there's some elements of that in some of these bills that the president's talking about, in helping to facilitate training in the direction that would drive the economy. But that's a long way out to sort of see the payoff there. And in the near term, I imagine there'll continue to be a shortage of labor in particular areas where truck drivers, right? Great example. And we're just going to see more and more robot trucks, I think, as time goes on, in order to alleviate that kind of strain.
Yeah. You talked about leadership and the rotation. I know last year when you met with us, you were talking about the rotation from growth to value, which has played out this year. And even in the small cap space, that's been a strong subclass to be in this year. Do you, as you look forward, not just international, but here in the US, do you feel like value will continue that run, maybe continue to be the leader? Do you see growth do you see another rotation from value back to growth?
I think in the near term, it's possible, as depending on how big this COVID wave is. When we get these COVID waves, we rotate back into defensives. But I think the trend through that noise is going to be further towards value. When you think how far the stock market's come, I think as of Friday, we hit our 66th new high for the year in the S&P 500. I think we've only surpassed that record back in 1995. I mean, it's been just an incredible year of hitting new highs. but it's been on new leadership. And I think that's what people miss sometimes is that, oh, how can it keep going higher? Because it's different stocks that kind of went nowhere for a while, like financials. Sector was left for dead for a decade. It's now coming back, and the best performing sector, one of the top 2 performing sectors this year, energy. Who thought energy would be great? Leading sector this year. So we're getting to those new highs on new runners, right? We passed the baton to a new sector and they're out there charging ahead. And that's why I think value still has that ability to perform. Valuations are not extended for these stocks and earnings momentum is still there. So yeah, I think there's still some potential there for value to continue to perform in 2022.
Okay. I'm going to shift here. So cryptocurrency. So it's here to stay. But at this point in time, how do you view that? How do you view that as an investor? How should investors view crypto? And then even longer term, where do you think it kind of settles in at?
Well, at the moment, I view it the same way the Financial Accounting Standards Board views it, which is an intangible asset. It's not cash. It's not a currency. It's an intangible asset, like art or something, so obviously it's soared in value here. Now, the challenge is, we don't view that as kind of a traditional asset that you would put in a portfolio because we're just not sure how it behaves. There's a lot of talk of it. Is it an inflation hedge? It hasn't necessarily performed that way. But I think as you think longer term, and particularly with this potential slate of new governors at the Fed, you can expect to see Fed coin coming out. It's been 7 or 8 years now that the Fed has had a proposal for its own digital currency, where we would all not have to, go through a bank, but essentially have accounts at the Fed. And that is something that is moving forward slowly, but certainly probably a direction. I think stable coins and Fed coin probably make some sense longer term as as things we actually use. I think, Bitcoin, Ethereum, others, I think not really a lot of use as a currency for a lot of different reasons, and we're unlikely to see that. The transaction volume just couldn't be maintained. But I think some of these others, more centralized systems, maybe make some more sense and are viable longer term. So the infrastructure around digital currencies makes sense. Blockchain makes some sense, but I think you got to be careful sort of picking winners and losers and getting too excited with any one particular coin, because I think there can be, again, a lot of volatility there. I don't know where they're going, but I can tell you that the future probably looks a bit different from a regulatory standpoint than what we've been in the last 10 years.
Yeah. All right. How about ESG investing? So that trend continues to build momentum, probably on a global scale, I'm guessing. So how do you see that playing out now as we look into the future?
Yeah, this could be a big theme next year. Green stocks, and environmentally sensitive stocks. This both the infrastructure program and some of the social spending as well. A lot of the money there for green technologies and transitioning to a greener future. And that's true in Europe as well. They passed a new Green Deal last year. China's trying to clean up its manufacturing, which we know is a mess. A lot of the world's major governments putting a lot of money into these businesses that are driving green technologies. That could be huge next year. Those stocks really didn't perform that well this year. And I think that they really might shine next year, not only on fundamental growth because their earnings and revenues are going to pick up, but increasing investor interest as well. And having those two come together. Sometimes you have investor interest, but the sales aren't there. Sometimes you got the sales, but investors are looking elsewhere because oil prices are moving up or something. Now I think you've got both of those coming together could create a really bright outlook for these stocks. And it's not just one industry or sector or country. If you take a look at, for example, the S&P Global Clean Energy Index, 23%, I think, of that is the US, just as an example. It's the biggest individual country weight, but 70 some odd percent of it is around the world, right? Emerging markets, developed markets, Europe, Latin America, Asia. So you can still have a diversified portfolio and have this theme in your portfolio and not feel overly concentrated like just in US tech stocks or Japanese real estate or something where there's a big risk. You can diversify that and at the same time benefit from the overall theme.
All right, looks like we're running short on time, and I think we've caught most of the questions. Maybe I'll just end it with, the sense that I'm getting is that overall you're feeling optimistic heading into 2022 at a global on a global level. I guess if there was one thing that would keep you awake at night, what would that be?
I think probably it's still COVID and just not knowing, what more mutations we could have and how far that could go. It's an enormous risk. I think that's out there. There are so many other risks that, the pandemic kind of a little bit came out of nowhere. What was it last week? We saw some piece of space junk almost hit the International Space Station. Hey, what if it hit some of our satellites, GPS communication satellites, set us back in terms of that? For what would that do to logistics? What would that do to communication? What would that do to trading for a while? Like these things that come out of left field that are hard to plan for. They're ever-present risks of investing, but they're often things that in hindsight, people go, oh, you should have seen that coming. Well, it's out there. So a lot of things that keep me awake because I can't forecast them. They're unforecastable, but they are big risks were they to occur. They're those tail black swan events. But I think if we focus on the things that we can measure, inflation, I'm not that concerned about Fed rate hikes. I'm not that concerned about, excessive wage growth. I think what wage growth we're seeing is great. It's good. It's well-deserved. I think instead, the bigger risks are around the COVID picture where it's just so hard to say.
Yeah. All right. Well, I think that's, I don't see any more questions coming in, and we're running up against the end of our time. So again, thank you so much for joining us today and sharing your thoughts. I know that our clients really appreciate you taking the time. And for those of you that joined us today, thank you for taking the time to join us. And we will plan to have you back next November, and we'll see what the topics are at that time. So again, thanks a lot, and everyone have a great day.
Thanks, everyone. My pleasure.